Hi guys, so we're here with Willie Smith with Preferred Rate. Willie, thank you so much for coming here. I really appreciate it.
Hey,
Happy to have you, man.
hey, no problem at all. I'm excited to be here, and we have some great stuff to talk about.
Oh, yeah.
So let's go.
I'm excited. Well, before we jump into it, would you mind just telling the folks a little bit about yourself? Your background, whatnot.
Yeah. So I guess I can say I'm an old man in the business now.
Oh, man.
It's going on 20 years in banking.
20 years.
And quite frankly, I can't see myself doing anything else. I cut my teeth, quite a while back, in the traditional bank. Few years later, I came over into the mortgage banking world, and I've been there ever since. Happy to be married to a wonderful, beautiful wife. Have
Awesome.
3 sons, and just living the dream. And real estate and the opportunity to help and serve others has been the core of my professional life for a very long time now.
So 20 years. So you started way back.
Yeah, that's right. That's right.
And you grinded through the '08 recession.
Yes, absolutely. It was but as with most things, there's cycles, periods of where things are, really, really good, and periods where things can be a little bit sticky.
Yeah.
So the one thing about real estate that we both can attest to, that you'll have periods of ups and down and ebb and flow that goes in sometimes a great direction, sometimes in a bad direction. But over time, generally speaking, we know that it's an upward trend. And when the dust settles, if our clients hang in there, we hang in there.
Yeah.
We know that real estate typically is going to be on that upward projection.
So not only you invest in property, you invest in yourself with the.
That's right. Yes.
That's awesome. That's awesome.
Absolutely.
And you said you got 3 kids.
That's right.
And when you jumped into the mortgage industry, you were just in the banking era, and then eventually you got into the mortgage part of it.
Yeah. So in the beginning, it was just a traditional bank. Open up checking accounts, savings accounts, credit cards, car loans. Savings accounts, CDs, things like that. So I really like the lending side of it. Didn't really care for the teller side and the balance and checkbook side and those type things.
Yeah.
So I did like the banking piece and the lending, and that's what kind of attracted me to go over to the mortgage corp, because in that situation, I know that I was only going to do the lending piece, and not deal with some of the other fun banking stuff that you have to do from time to time.
Yeah. Well, you specialize in VA loans, right?
Yeah. So VA, I'm really blessed in that, my wife served for 13 years in the Navy.
Wow.
And, have different family members that have served. And, just over the years, it's been a demographic that's been such a big part of my life. It became very natural to serve that demographic with their home buying needs, and,
That's cool.
Teaching how to leverage VA home loan benefits and, different things like that. So, every opportunity we have to be able to serve and to be able to give back to those who, basically sacrificed it all for us to have the liberties and the freedoms that we have right now.
Oh, yeah, 100%.
It's a really big deal and a very big part of my business.
Wow, that's awesome. Yeah, no, I mean, without those guys, I don't know where we would be, man.
Yes, absolutely.
Yeah, so tell your wife thank you for her service.
Thank you.
Your company and you as a mortgage loan officer, what sets you apart from the others?
So I would say this, you can go to, these days there's literally a bank on every corner, and it's also, and the online opens up even more to you.
Yeah.
So, clients have options.
Yeah.
Everybody has options on who they're going to use. We really try to pride ourselves on breaking, the process down into basically 3 pieces. We want to, one, establish a budget. Number one, you can't do anything or do it smartly as it relates to finances without setting that budget first. Number 2, we want to craft your mortgage plan based off of that budget that you set for yourself. And then number three, we want to make sure that we implement, that mortgage plan that we set up so that we can help the client build wealth and legacy through the acquisition of real estate.
Yeah.
So can you go anywhere to get a loan? Well, yeah, you can. But we want to differentiate ourselves and add the value of helping you budget, helping you create a plan, which is going to help you meet your short-term and your long-term financial goals, and then helping you put that plan into effect so you can build that wealth and legacy for your family.
So it's kind of just like not just buying a home. It's kind of just turning their finances around and making sure they're building wealth.
Absolutely. Absolutely. Yeah. I have a certified mortgage planner designation. So it basically means we're looking at not just the mortgage. We're looking at the mortgage, what tax strategies you may need to consider,
Wow.
Hey, making sure that you're investing properly, is looking at the full picture, because there's so much more to the mortgage than just what's my interest rate, right? What term? Hey,
Yeah.
Does it make sense for you to do a 15-year versus a 25-year versus a 30-year? Does it make sense for you to do a rate buy down? Does it make sense for you to do an adjustable rate? Does it make sense for you to, buy a second home? Does it make sense for you to start buying investment properties? Does it make sense for you to refinance? Does it make sense for you to do a cash out, debt consolidation? It's so many things that are part of that puzzle, outside of just what the rate is.
Yeah.
Now, of course, the rate is certainly something that you have to consider.
Sure.
But you also have to make sure that you're in the right product. And that's something that's really crucial. You have to, and in order for you to be in the right product, you have to be on the right plan.
Yeah.
So everything kind of goes in together.
It's a big commitment.
That's right. Absolutely.
And you got to have a professional to guide you through the whole process.
Absolutely. Absolutely.
Got it. Yeah, I guess let's just dive into some questions. I was thinking, let's say for people that haven't bought a home, kind of just in the beginner stage.
Mm-hmm.
So, I looked at Credit Karma. It says I can get a loan.
Right.
Where do I go from there?
Right.
What would you say? What's the good place to start?
Well, I'll always start with the first thing I say is the B word, establishing the budget. Before you sit down with any banker, mortgage professional, mortgage broker, any type of lender, you want to have looked at your financial situation and determine what you know that you can afford. Tell clients all the time, you want to establish your budget first and find a house that fits your budget, not find the house and make your budget fit the house.
That's awesome.
So the first step is establishing the budget and knowing what you can afford.
Yeah.
One of the biggest mistakes that you can make is go into the bank and ask the bank what you can afford.
Yeah.
Because we're trying to lend you as much money as we can. I tell clients all the time, I want to lend you $1 million,
Yeah.
right? But if you know that, you can't afford something, well, don't take that amount of the loan.
Yeah.
It's that responsibility.
Yeah.
So the first step that I would say is establish your budget first. And that's with any major financial decision, whether you're planning a wedding, planning a vacation, buying a car, whatever, start with the budget first step.
And then go from there.
That's what's going to keep you out of trouble.
Yeah. No, I mean, I always hear, every time clients want to shop for a home and they're like, hey, I'm approved for $250. I'm like, hey, try to be in 200s if you can,
Right.
But, sometimes people will be like, well, let's do 260, 270. So
absolutely.
Yeah.
And again, it's good to be able to, in my opinion, two numbers that you want to have. You want to have what your absolute ceiling is that you set, where you're saying, you know what, no matter what, I'm not going past this payment.
And that's important.
Right.
Yeah.
And then the next thing you have is what your comfort level is.
Yeah.
So you may say, hey, I'm comfortable with the $2,000 payment. That's my comfort level, but my ceiling may be $2,500.
Yeah.
So then now you can determine what range you're going to be in. And then typically most people fall within their ceiling and their comfort level, but you have to have those things established.
Okay.
Then once you have that established, again, the next thing is just making sure that your finances are intact. Hey, the bank is always going to look at income, employment, assets, credit, right? We want you to have responsible credit. We want you to be solid with your asset accumulation. We want you to be consistent with your income. And we also want to show that you're getting up and you're going to work. You're gainfully employed, and having consistency with your employment. So looking at those things determine the if you can buy, right? Yeah. So again, we're looking at, like 4 corners of a house: income, employment, assets, credit. Those are the next pieces. So after you establish that budget, and now you have an idea of what you want your long-term and short-term, goals to be financially, now it's making sure that each one of those buckets, everything is you're getting a check mark, knowing that those things are positive. We're kind of getting some basic things up front. Hey, are you a first-time home buyer? Hey, are you a veteran or active duty? Hey, what's your comfort level as far as a monthly mortgage payment? How soon do you want to move? How much have you saved? Do you have a 401k? We want to be able to get that overall picture first. And then from there, again, it's a matter of crafting a plan that's specific to you, because everybody's mortgage situation is so different. Everybody, you go from the first time home buyer to the veteran who's using their VA benefit, to someone who may have lost a house in the past through foreclosure or banks or bankruptcy and they're a little afraid, to somebody who's, has a rich uncle who's giving them a 20% down gift. Yeah. Like, it's so many different scenarios that are there. So until you can establish, what the client's needs are, it's really hard to be able to recommend what direction or what type of, a mortgage product is going to best suit the client's needs.
Yeah. And I mean, and not only that, where they find out the hard way, what they can or cannot do. It's just, it saves them a lot of, I guess, time and emotions. Because
that's right.
Sometimes people just jump into it.
That's right. That's right.
And not get pre-approved and not talk to a lender, and then
that's right.
Find that perfect home. Boom. Oh, I can't get that off.
Yes. I advise them to, that first step, that pre-approval step is absolutely critical to smooth out this process. For sure.
So I guess that pretty much covers why they should get pre-approved. What would you say would be the difference between obtaining a loan from a bank versus a lender?
Right. So, you hear a lot of narratives surrounding it. The bank, lender, broker, correspondent lenders, like all types of things. The biggest thing is you get the relationship with the right person. That's the thing, right? A conventional loan is a conventional loan is a conventional loan. FHA is FHA is FHA. Right. VA is VA is VA. USDA is USDA is USDA. You can go to a myriad of places and be able to get a loan.
Right.
The difference is with the particular person. Find someone that you're comfortable with. Find someone who's respecting, what your goals are, and find someone who is crafting that plan that's best for your particular situation. So I can have 4 clients in a row, and all of them are going to do FHA, and each one of their scenarios can be completely different. Yeah. So, it's not so much which outlet is better or worse. It's a matter of which outlet is best for you as an individual, and which outlet you feel is putting you and your family in the best possible situation. Because the different outlets, again, you can get a mortgage from anywhere, but getting the mortgage that's absolutely catered to meet your needs and your goals, that's the outlet that you're looking for. That's the person that you want to lock arms with and be able to say, hey, this is who I'm going to use to get my mortgage.
Okay. How would they calculate what they can afford?
So that's a good question. What I do with my clients is give a very, very basic budget worksheet, and I provide it to them, and I want you to just sit there and put down how much money's coming in, right? How much money is hitting your direct deposit?
Yeah.
Like, how much real cash do you have each month? And then from there, you're looking at subtracting out all of your bills. You know, what do you have to pay? And then once you see what your income is, then you say, hey, these are what my debts, this is what I'm responsible for each month. Then when you see what's left over, that kind of gives you a good idea of how much you can afford mortgage wise. So again, you don't want to get in trouble where you look at it and you have $1,500 left over and you go get a mortgage for $2,200, right? Because your budget tells you can afford $1,500, but the bank told you that you can qualify for $2,200. You have a problem. Because one of the big things is the bank calculates what you qualify for based off your gross income, but you pay your bills. It would be net. It would be great if we got our gross, right? But if you're being qualified off your gross, but you're paying bills off your net, you have to be really careful to make sure that you don't get yourself in a sticky spot.
Okay. Yeah. I mean, you know, I think a lot of buyers start off with good intentions and they're like, all right, we're going to keep it cool. Not going to go over the budget. But the moment you get into a house,
that's right.
You'll see like, well, this house is that, and that
that's
house
right.
is this.
That's right. That's right.
Extra room, or the
that's
patio,
right.
or the bigger yard, the dog. So immediately, just like boom, 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 then the price starts going up. So it's easy to get to get out of hand.
You have to go in and you have to draw that line in the sand. You have to, because you know what you are approved for is a finite number, right? At some point in time, you know. You have to be able to say, you know what, I'm not going past this on a monthly mortgage payment, or my budget, or my lifestyle, or the responsibilities that I have do not allow me to pay more than this amount. And you have to come to grips with that. So if you love the $500,000 house, but you can only afford the $400,000 house, where you're going to have to make some type of adjustment there. So that you're not putting yourself in a sticky spot and biting off more than what you can chew. You want to be able to live well within what you're able to afford.
With people trying to get their finances in order, a lot of times, you know, in the country, some folks can get a mortgage and don't think they can.
Right.
They'll think like, well, I got to go do this, and I got to do that, and I got to pay this off.
Absolutely.
And in reality, they can get a mortgage at a good rate.
Absolutely. So a lot of times we talk ourselves out of it. You know, and you know, and there's so much information out there. You know, I tell clients all the time, the good thing about Google is a lot of information. The bad thing about Google is a lot of information. Right. So you want to be able to go in and get that information and be familiar with the process. But ultimately, you want to be able to link up with a mortgage professional and a real estate professional like yourself is going to be able to take that knowledge and be able to apply it to your particular situation. Right. So when you're going in, you know, just thinking through getting the best people on your team that are going to be able to give you the absolute best advice, and don't look at your situation and talk yourself out of it. Because when you come and you talk to my team, one or two things are going to happen. Either everything is good, and we're going to tell you what you're going to do next. Or things are a little sticky. But we're still going to tell you what you need to do next. So no matter what side of the street you land on, we're going to help you with that plan to get you to that ultimate goal of being able to purchase a home. So, you know, I just encourage the client, don't talk yourself out of it. You know, it may not be as bad as you think, or it may be a situation that you think may hinder you when in fact it may not. So get with the professional so that you really truly know where you stand, and then you can be very concise and very educated on what steps you need to take next.
So it's not a question of if, it's a question of when.
That's right. That's right.
As long as they got the right guy.
That's right. That's right.
I've seen this a couple of times with clients where you've got couples and they think that they both need to apply, and then maybe one has good credit, one doesn't. And would you talk a little bit about like couples where actually one person can apply, you know, as versus both of them applying and maybe not getting the loan?
Right, right. So it happens quite a bit. I always encourage them in the beginning that if they're a couple and both of them have the income, go ahead and apply jointly, because being able to use all of the income typically is going to give you a little bit more flexibility. Not always, but typically, the more the merrier.
Yeah.
But there's also times where you may have, the couple, and one of them may not be as strong as the other one, whether it's, income's a little sticky, whether it's, credit is not where it needs to be. So I always, again, say start off jointly. But then if I look at it and then see that it doesn't work jointly, but individually, one or the other can do it by themselves, well, what we'll do is we'll update everything, strip out that other one who we're going to take off, and then just move forward with the one, client or borrower that does qualify. It's, again, we're trying to figure out how to say yes.
Yeah.
We're not trying to figure out how to say no.
Yeah.
So if we can say yes with both of you, okay, more power to it.
Yeah.
But if we need to lose one of them and just use one of them in order to make it happen, well, we're most certainly willing to do that.
Yeah.
So when you're going in, and again, it leads back to who you're going to do business with. You can tell when you have that conversation, and typically it doesn't take long. You can tell pretty quickly whether that's someone that you can work with or not.
Yeah.
Or is someone who's really going to roll up the sleeves and go through every possible scenario to try to get you into that home.
Yeah.
So that is something that you're looking for. You're looking for someone who's trying to figure out a way to say yes. Now, you have to give them something to work with, right? Which still goes back to income, employment, assets, credit, right? So it doesn't matter how hard somebody works. If you don't have income, employment, assets, credit, and you can check off those boxes, it may be a little sticky with you being able to qualify. But even if you don't have those, that person should still be able to formulate a game plan to tell you, hey, things may not fall within guidelines now, but if you do these things and you take these steps, we can get you there.
Yeah.
Because like you said before, it's not a matter of if you can buy the house, it's a matter of when you're going to be able to buy the house.
And it's super important for the information that they provide you to be very accurate.
Absolutely.
Because, pre-approval versus pre-qualification.
That's right.
You're issuing pre-approval, so you're digging in there, getting all the information.
That's right. That's right.
It's very important for them to tell you what's exactly how it is.
That's right.
So that the feedback they get from you is exactly how it is.
That's right.
And there's no, okay.
So the pre-approval, as my team, we don't do pre-quals at all. Yeah. Pre-qual typically isn't worth the paper that is printed on.
Yeah.
It's all verbal information. Nothing's verified. A lot of times it may not even be a real credit report. Pre-approval, we are doing a full application, a full credit review, and we're reviewing, again, income, employment, assets, credit, to make sure that you have a solid opinion as it relates to you being able to get a loan. So when you go out there and you start shopping and you find something that is within your price range and when within the parameters of the loan that you've been pre-approved for, you can feel pretty comfortable that you're going to be able to get that loan. So do the diligence up front, do the heavy lifting up front, be forthcoming and upfront with, the situation, because the bank, I tell clients all the time, the bank is CSI. When we're giving you hundreds of thousands of dollars, made a mistake there, not lending you hundreds of thousands of dollars. We're going to do our diligence to make sure, hey, this is a good risk for us and we're going to get our money back. Yeah. So be prepared and be prepared to be able to, put your best foot forward. You want to be able to present yourself in a way that the bank is saying, and again, the bank isn't looking for perfect, but we do need to see responsible. Yeah. There's very few people walking around with perfect credit. Yeah. I've been in the business a very long time and you don't see perfect credit every day, but we want to see responsible. Yeah. We want to see when you borrow money, you're efforting to pay that money back on a consistent basis.
Which is a fair ask.
Absolutely. Yeah. Absolutely. Now, again, maybe a couple bumps in the road here and there because life happens to everybody, but we want to be able to see, overall responsible, overall consistency with income and employment and all those things. We just want to be able to feel good about lending the money. And that's what the banking guidelines are for. Hey, let's set these guidelines and these parameters. We want the clients to be able to fit within these guidelines and parameters. And then that gives us the opportunity to be able to lend.
Yeah.
So if we can fit in there and make it where your financial picture is being painted in a way and presented in a way that you're a good risk for that loan, where you have a good opportunity to be able to get financing.
And that's what makes me confident. Well, I won't say confident, but it makes me feel good about the market, because I think one of the things that where a lot of people are freaking out about what's going on, recession and whatnot, is, and I don't want to get into predicting the market or whatnot, but it just, the banks are so much different now that lenders than they were back in a day where anybody got a loan. So you guys just a crazy amount of homework to make sure that loan you get, you can pay it off.
That's right.
So we're not going to be seeing that, the amount of foreclosures we saw back in the day. We're not going to be seeing that right now. So it's a completely different ballgame now.
Yeah, the Consumer Financial Protection Board and Dodd-Frank and all of the things that got implemented after 2008, 2009, it really is forcing lenders to do the responsible lending. It's really not the right thing to do to give somebody a mortgage loan on something that they can't afford. It's just not the right thing to do. And that was a lot of what happened in 2008, 2009. You had clients that did not qualify for mortgages and they were being approved and getting mortgages.
It was crazy.
With just, scenarios that just weren't, that just weren't responsible. So right now they put a great amount on us as lenders and loan originators to make sure that person that we're giving that loan to, that they can afford to pay that back. Not just to protect us and our investment for the loan, because it's the right thing for the client as well.
Protects them.
Absolutely. And then the example, before when we were talking about budgeting, if you look at your budget and know that you can only afford $1,500, why would you go get a mortgage that's $2,500? It's not logical. It doesn't make any sense. So before, it was situations where that may have been, a little bit easier to do than what it is now. So we really want to be able to look at the responsible lending, right? So that you can get the house and use that as a tool to build your wealth, not get it and it be the first step of everything going downhill with your finances. That's not what we want.
Stressing out to make sure you can.
Absolutely. Absolutely.
Yeah, that makes sense. What would you say? Obviously, we did cover a lot about the first-time home buying. Any other advice you want to give to first-time home buyers?
Yeah. So the biggest thing is just understanding that everybody's situation is different. Your journey to buying a home may be different from grandma or mom and dad or brother or sister or neighbor or coworker. Understand that everybody's situation is completely different. Be prepared. Have your ducks in a row as far as your documentation that you're going to need. Have the basics together, your bank statements, your pay stubs, your W-2 forms, your tax returns. If you're self-employed, make sure you have your business license, all of your tax returns as well, particularly if you're self-employed. Just be prepared going into the process of knowing that the bank, we do want to lend you the money, right? Of course, we want to lend you that money over 30 years and you're going to pay us back 3 times what you borrow, right? That's a great deal for us, right? So we want to give you the loan, but you just want to be prepared knowing that you're going into a situation where you want to be prepared. You want to be realistic. It's going to be a little bit of fear there, especially if it's something that you're doing the first time. But understand it's something that's absolutely doable. And then also understand that you're taking that step to get you out of that rat race of paying rent. Right? You have to get out of that. Right? You're paying, because I tell clients all the time, you're already paying a mortgage. You're just paying your landlord's mortgage.
Not yours.
Pay something that you're being able to go and you're starting to build, that equity and that wealth and legacy for you.
Generational wealth.
Absolutely.
Something pretty kistly. I couldn't agree more. I was thinking about earlier. You were telling me when you came to Jacksonville 13 years ago. It was that was 2008, 2009.
Yep, right around that time. Right around that time.
That must have been a crazy time.
Yeah, it was a very interesting time to be in the mortgage business.
So everybody was getting out of it.
Yeah, it was very interesting.
Yeah.
I'll just say that,
I bet, yeah.
and literally like overnight, things just were very different. But, I tell people all the time, it was God's grace that got me through that.
Yeah.
To be able to just continue to still be able to work with my clients, come up with different strategies to be able to just make sure that as many people as possible were okay. Because when that situation happened, it was some people that were doing crazy stuff, but then there was also some people that were very responsible and kind of got caught up in the middle of some things as well. So it wasn't all, just greed or, bad products. It was just like a common, it was a perfect storm of things that happened in 2008, 2009.
Yeah.
So, so the biggest thing is what we should learn from that is being responsible, being responsible as the consumer, and then also being responsible as the lender.
Yeah.
So if both sides are really focused on sound practices, it could greatly work towards, lessening the possibility of something like that happening again.
But I like that. We want to lend you the money. We want to make
for
money.
Sure. Yeah, for sure.
Follow the guidelines, and we can make it happen.
Absolutely. We there is no shortage of money with the banks.
Yeah.
There is money for us to lend. The but is that it is a loan.
Yeah.
We're not giving it to you.
Yeah.
We're and we don't want the house.
Yeah.
The house is collateral. Because sometimes we hit a mindset, if I don't pay it, you get the house back. We don't want the house.
Yeah.
We're not real estate. The bank isn't necessarily wanting to acquire and hold property. What we want to do is lend the money at a fair interest rate, and we get our return back, that interest. Yeah. That's what we want. We didn't want the interest. We don't want the house. Yeah. So, so again, the mindset of knowing we want to lend you the money. We are not trying to figure out ways to say no.
Yeah.
Now, again, I would be, silly to say that, hey, in the past, or there's been situations where certain demographics and different things may have been underserved or treated, wrong in lending practices.
Yeah.
Let me say that. Yeah. Things have happened. Yeah. But I will like to say that there's been a lot of things that have been put in place, and still being put in place now, that if someone qualifies for the mortgage, again, they can check off the boxes: income, employment, assets, credit, and they can show that they can afford it. Yeah. You have a very high likelihood that you're going to be able to be approved for that mortgage.
Yeah, I think we've come a long way with this.
Absolutely.
All of this they implemented to make it fair. Yeah.
Yeah. So there's still work always need to be done with things, but 100%. There's definitely progress made as it relates to that.
I'm happy to see that.
Yes.
How long does the approval last?
So there's no hard set rule, but typically it's about 90 to 120 days. But it's not necessarily that the approval goes away. What happens is that documents and credit reports have a shelf life. Mm-hmm. So typically we want documents that are going to be, within 30 to 60 days. And typically we want a credit report that's 90 days or less. So if you go through your pre-approval and now it's 90 days from now we want to be able to check your credit again to make sure you didn't go buy a Bentley, right? We want to have updated pay stubs to make sure you're still working. Yeah. We want to have updated bank statements to see, hey, are you still saving and doing what you need to do? So again, a good rule of thumb is once you're issued the pre-approval, about 90 days. But then after that period of time, it's just a matter of updating. Typically, you don't have to start all the way over from scratch.
Right. And that's something that banks and lenders don't like, is change.
Right. Yeah. We don't want any surprises, especially if you're in the middle of the process. You want to, I tell clients all the time, shut that credit down. Yeah. Don't do anything. Stop using the credit cards. Don't take out any new loans. Don't let anybody pull your credit. Keep paying everything on time. Just shut it down. Yeah. Do what you need to do, because we are going to scrutinize, we're going to scrutinize that credit application.
Yeah.
We are going to literally look at it from A to Z. We are going to go CSI on that credit file just to make sure that, again, we're making a quality loan.
Right. The loan to value ratio. Can you just touch on that a little bit?
Yeah. So loan to value is basically boiling down to how much the client is initially putting down. So, you know, if a loan has 100% loan to value, like a USDA or a VA, that means they're doing a zero down loan. You're taking whatever the value or the sales price is, the lesser of, and we're giving you the loan for the full amount. Now, when you get into, like, for instance, FHA, where your minimum down payment is 3.5%, well, you take that 100%, you take away the or subtract the 3.5%. So now you're at a 96.5 loan to value. Or if you do a conventional loan and you put down 3%, okay, now your loan to value is 97%. 5%, it would be 95%. So loan to value is basically a calculation of what your loan balance is versus whatever your sales price or your initial appraised value.
So just another way of looking at a down payment, basically, right?
Basically.
Right. And
so LTV is basically that's all it stands for. What your initial loan balance is as it relates to the lesser of the sales price or the appraised value.
And obviously there are closing costs, and we're always the ones. I always tell the buyers that sometimes they're not aware that down payment isn't closing costs. There's two separate things.
Two totally different scenarios. That's a great point. And is one that gets confused a lot, right? But the way that I try to break it down is I always tell the clients, you know, just think about having 3 buckets of money or 3 piles of money. Bucket number 1, upfront costs. Those are your binder deposit or earnest money deposit, your home inspection, which we recommend, and your appraisal. That's bucket number 1. Bucket 2 is going to be your down payment. Well, you know, if it's a zero down loan, there's nothing in that bucket. But if you do a loan program that requires 3% down, 3.5%, 5% down or more, that second bucket is going to be for your down payment. Third bucket of money will be your closing costs. You know, those are the fees that are associated with the transaction so that the ownership of the property can properly convey from the seller to you. You know, it may be your taxes, your insurance, your deed stamps, your attorney fees, your title insurance, all of those things. So when you're going in, a decent rule of thumb, 3.5% to 4% of your sales price pretty much nails your closing costs. But when you're going into the transaction, understand 3 buckets. Upfront, down payment, and closing costs. Three distinctly different buckets as it relates to the mortgage.
I like that analogy. I think I'm going to steal that. I'm going to use that.
No problem, because I think I stole it from somebody.
There you go. Because I get emotionally involved with my clients, and as they're like going through it, I'm going through it. You know what I mean?
That's right.
Because every deal is like, I don't know what it is. It's like you got to make it your own.
Yes.
You got to treat people how you would treat yourself.
That's right.
So I feel like the more anxiety we can remove from the process, the better for them. I don't want them stressing out, because it can be an emotional roller coaster, buying a house or selling a house.
Yep, absolutely. So, and what it boils down to is a lot of the anxiety is going into the unknown. Or not getting their questions answered.
So right,
And I know you pride yourself on answering questions, and my team, we try to, because it's one of those things where the unknown, it's like the dark room. What makes you afraid of the dark room is that you don't know what's in there. Right? Sometimes it's not always the dark, it's dark and I don't know what's in there. That's what's making me afraid. But if you can assure me that there's nothing in there that's gonna, bite my head off, I'm not as afraid of the dark room. But when you're going into the mortgage transaction and you don't know, you don't understand, hey, what happens next? Hey, what does home inspection mean? What does appraisal mean? What does going into underwriting mean? What does clear to close mean? What is the difference between my down payment and my closing costs? All of those things they're unknown. So now it makes you fearful, or your anxiety goes on 10 because your questions aren't being answered. Because of the unknown. You take away the unknown, it takes a lot of the fear and anxiety away.
So we're here to shine a little bit of light in that dark room.
That's right.
locking in your rate, sometimes rates do expire or change, et cetera, et cetera. And locking in your rate prevents that from happening, right? Could you touch on that a little bit?
So typically, for the most part, now there are some, you know, kind of real specialty products that maybe, you know, have a little bit different, you know, terms to them. But for the most part, your rate isn't locked in until you're under contract. So you go in, you get your pre-approval, you go out and shop, you find the perfect house. Now you're under contract. You have a set closing date. At that point in time, typically that's when your interest rate is locked in, because, you know, for the most part, you're locking in your rate for 15, 30, 45, or 60 days.
Yeah.
So that happens once you're under contract. Now, once your rate is locked, is locked. If rates go up, you're locked. If rates go down, you're locked.
Yeah.
Now, again, we don't want to get into the small details of, you know, what happens if you lock your rate in the rates absolutely tank and the lender renegotiates your rate, stuff like that. So those are things that are possibilities. But generally speaking, you're going to go under contract and your rate is going to be locked once you're under contract. So at pre-approval, when you're running your numbers and going through the scenarios and saying, hey, what's your interest rate? It's best. And what we typically do is give a range. Hey, rates have been ranging between here and here over the last 60 days or 30 days or whatever, because those rates, it could be some movement from the time that you got issued your pre-approval letter up until the time where you go under contract and it's time for you to be locked in. So again, I would say the majority of scenarios out there, the client is going to actually have their rate locked once they're under contract and we know a particular date. So we know how long we need to lock it. And then we're going to do it based on what the market is at that time that the lock is available.
Okay. All right. And this, I don't get that as much, but I've seen it a lot of times. When people are unfortunately going through a divorce, and they want to get pre-approved. And so I've had a number of clients where they're like, you know, do I just go through with it first and then apply, or how would you say they should go about it? So
the easiest thing is to do it post-divorce,
right?
Because everything has already been settled and you know, basically new season, new start.
Yeah.
If it is a situation where you're going to do it prior to you being divorced, you also want to be very specific as far as which state you're in. Because, like, for instance, you and I do a lot of business in Florida. If you're still married, you buy a house, both people are going on title for the majority of the time.
Yep.
So if you're buying a house ahead of time and then you're about to have your soon-to-be ex still need to be on title, sometimes it makes it a little bit sticky of a situation. Now, some other states don't require that and you can do it ahead of time, you know, and then sometimes you can do things based off your separation agreement, like if certain bills are the responsibility of one over the other, etc. So if someone is divorced, is really no straight answer for every situation. It's one of those ones that we will, again, look at it case by case, because sometimes I said, you know what, there's a lot going on here. It's probably best to go ahead and get this divorce settled and then do it. But then sometimes it's situations where it does make sense to go ahead and do it ahead of time. If we can make it work, or they really need to get the kids registered for school. And it's just so many different variables and emotions that are flying when you're trying to purchase a home, you know, during the divorce. So that is something that we take a very deep dive on the consultation to be able to say, hey, which one makes sense? Do we need to move forward before this is done? Or should we wait until, for lack of a better word, the dust is settled and then everything has been separated out? Then we can start on this new journey.
Okay. And speaking of different states, you're licensed in Virginia. And
right now I'm Virginia, Georgia, Alabama, Florida, North Carolina is soon to come. Actually my company is, you know, in just about all of the states.
Right.
So even if I can't personally do it myself, I can refer to one of my counterparts in another state that, you know, can be able to do a great job for you.
They can take care of them.
Absolutely.
That's awesome.
Absolutely.
How would you say student loan affects the loan approval?
So that's a very good one. So student loans is it's a problem in the United States.
Yeah.
You know, you see a lot of student loan debt that's out there. You know, so the thing that I'll tell anybody that's listening is that don't automatically think because you have a high student loan balance, you're not going to be able to qualify.
Right.
Do not think that, because there are different steps and there are different things within mortgage guidelines that allow, you know, the possibility of you still being able to get your mortgage loan, even if you do have, you know, student loan debt. It is one of those situations where you want to sit down with your mortgage professional and look at your scenario. Because when you're calculating debt to income ratio, when we're calculating how much you're going to get qualified for, depending on the status of the student loan is going to determine how much we count against you. So for instance, if you have a $100,000 student loan, you're doing an FHA loan, we're going to count 0.5% of the balance into your debt to income ratio. So on a $100,000 loan, we will be counting $500 against you. Okay. But that same loan, let's say you were in an income-based repayment plan or income-driven payment plan, and the income-based or income-driven payment is $100. Well, then now instead of us having to count $500 against you, we're only counting $100 against you. So what I would advise anybody, if you have student loans and you think that it's possibly something that may get in the way of you purchasing a home, sit down with the mortgage professional so we can look specifically at the status of those student loans and either say, hey, this is fine, this gives you the best opportunity to qualify, or you're in this status, maybe you should change it to this status. And as long as it doesn't put you in a sticky spot financially, that might be able to get you to where you want to be a lot sooner. And so student loans aren't a death sentence.
That's part of the financial planning that you offer.
Absolutely. Absolutely.